Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Shaily Engineering Plastics Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Sanghvi, Managing Director at Shaily Engineering Plastics. Thank you, and over to you, sir.
Thank you. Good morning and a warm welcome to all the participants to the post-results earnings call of Shaily Engineering Plastics. I hope all of you are keeping safe and healthy. I have with me Sanjay Shah, our Chief Strategy Officer, and SGA, our Investor Relations Advisors. I hope you've had a look at our investor presentation that is uploaded on our website as well as the stock exchange. With each passing quarter, we have been registering growth in our top line sequentially. I'm pleased to share with you that our 9-month results this year have been far greater than any of our full-year results thus far. Our new plastics facility at Halol is up and running, and we're gradually improving utilization there. Orders received over the previous quarters are gradually picking up pace, and momentum will be continued during the period to come. We are actively working at our Design and Research Center in the UK, and I'm glad to share with you that under Shaily UK, we have acquired 2 additional patents for both pen injectors as well as auto injectors. The scope of this business is immense, and we're working very diligently to maximize this opportunity. Our objective is to be a leading player in self-administered injection systems globally. There have been quite substantial business development efforts, and we're finally seeing the fruit of the same. Apart from Europe, we've also started catering to Middle East markets in this segment. We are deepening our foray across contract manufacturing of medical devices, developing our own IP and products and platforms, as well as specialty packaging. It is our ability to develop IP and our own platforms that are finally paying off. We currently have a total of 5 platforms for various molecules and are working towards developing the auto-injector for a particular molecule. We've also received confirmation business awards for 2 additional injector pens, which will be developed in Shaily UK. Talking a bit about business from our largest customer, we see as they are increasing their footprint in domestic as well as global markets, we're also equally getting our share of growth from the increased pie, and we continue to be an important part of their supply chain. I would like to announce expansion projects here as well. We will be expanding our brush manufacturing capacities in the current year, and the new capacities will be operational by Q1 of FY22. Under our automotive and engineering business, we have received confirmation for 3 additional actuator rods, which contribute to a fairly large business value in the automotive segment. We will start commercializing these rods from calendar year 2023. We have raised funds at the beginning of the current fiscal year. We've started utilizing it to expand not only our core business of home furnishings, but we're also investing in toys and healthcare. We're planning to spend approximately 200 crores over the next 18 months, out of which more than half of spend will be towards pharma part of the business, for growing device part, as well as scaling up manufacturing of devices where we've created our own IP. Before I hand over the call to Sanjay Shah, our Chief Strategy Officer, to give you an update on operating and financial highlights for the quarter, I'd like to share an update with you. Our CFO, Chintan Shah, has resigned from the post, and today will be his last working day at Shaily. We thank him for his contribution towards success of Shaily and wish him best for his future endeavors. Thank you. I would now like to hand over the call to Mr. Sanjay Shah.
Thank you, Amit. Good morning, everyone. I shall share with you the highlights of our operational and financial performance of Q3 and 9 months ended FY22, following which we will be happy to respond to your queries. During the quarter, we processed 5,321 tons of polymers as against 4,444 tons in Q3 FY21. In Q2 FY22, we processed 4,498 tons of polymers. For 9 months FY22, we processed 13,912 tons of polymers as against 10,246 in 9 months FY21. Machine utilization was 61% in Q3 FY22 as against 70% in Q3 FY21. It is due to additional capacity being in place in Rania and the new Halol plant. It will ramp up. Machine utilization will ramp up in the coming quarters as we move forward. Exports during 9 months FY22 stood at 79% of total revenue as compared to 72% at the same period last year. Now I should brief on the standalone result highlights. Revenue stood at 148.3 crores during Q3 FY22 as compared to 105.5 crores for the same period last year, marking a growth of 40.5%. On a year-to-date basis, 9 months FY22 revenue stood at 413.2 crores versus 9 months FY21 revenue at 250.8 crores. Commencement of commercial supplies from new plastic facility and ramp up of other businesses is helping us, the top line businesses, to grow. EBITDA for Q3 FY22 stood at 24.3 crores as compared to 18.9 crores in Q3 FY21. EBITDA margin stood at 16.4% in Q3 FY22 as compared to 17.9% in Q3 FY21. For 9 months FY22, EBITDA stood at 68.3 crores with 16.5% EBITDA margin versus 40.1 crore in 9 months FY21 with EBITDA margin of 15%. Net profit stood at 9.3 crores for Q3 FY22 versus 8 crores in Q3 FY21. For 9 months FY22, net profit stood at 27.8 crores versus 12.3 crores in 9 months FY21. Cash PAT for Q3 FY22 was reported at 16.5 crores as compared to 12.8 crores for the same period last year. For 9 months FY22, cash PAT stood at 47.4 crores versus 26.2 crores in 9 months FY21. Gross debt at the end of 31st December 21, including working capital, stood at 262 crores. For the quarter, we incurred capex of 19.41 crores. With this, I would like to summarize on the operational highlights front and let you all know that we are working actively towards diversifying our business model, and you will see better trajectory in quarters to come as new orders start ramping up. This is all from our side. Now we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, thanks for the opportunity. I have 1 question for Amit and 3 for Sanjay Bhai. Amit, is it possible for you to give a broad indication on the number of pens that probably will look to monetize or sell, say 2 years out? And potentially, if you can actually break it up between what percentage of it would be IP based. I presume currently that number might be low. I'm trying to just get a sense on how big the business can be, and given the mix between contract and IP, if it changes, how will it help us on the margin profile? That's the first question for you.
We currently do about 6.5 to 7 million pens per year. We intend to ramp this up to close to 20 million over the next 2 years. Exact timing will always going to be a plus or minus 2 quarters, so I won't be able to comment on that. But in this ramp up, what you will see is contract manufacturing to be about 7 to 8 million pens, and balance will be pens from our own platforms.
Sure. And if one had to look at the status, I think earlier we had indicated around IP base we had 5 injector pens. Can you highlight at what stage is it? Like the filings have already been done by the customers. Some broad color over here will be quite useful.
Yeah, sure. So one of our pens, Axiom, which is meant for delivery of teriparatide, has been filed, and the file is under review. Our customer has filed with the US FDA. File is currently under review, but we anticipate approval in the current year, and it will be launched on approval. So we should see launch happening towards the end of the year as well. One of our second products comes in 3 different molecules. 2 of those molecules have been filed. Third one is currently work in progress, but we should see approval for those molecules as well before Q1 of calendar 24. Then for Middle Eastern markets and some of the rest ROW markets, we're currently we've done the necessary documentation and registration work, and we will be starting supplies shortly in Q2 of FY23. On another platform, I'm not naming the platforms here because then, giving up confidential information. But on another platform, we have a product which was an NCE-1 filing, which has been filed by 2 of our customers in the US in December 2021. And even though approval might be end of the year, but launch based on current information will not be before 27. And then we continue to work on auto injector for an upcoming molecule. And we also continue to work on the new pen platform that we've acquired, which is innovative technology, slightly different than what we currently do. Again, for advanced GLP-1 therapy.
Sure, that's quite useful. I have a few questions for Sanjay Bhai. I think September balance sheet, it did indicate that the inventory had actually moved up. I think a part of it was attributed to toys, which I presume in the notes you have indicated that the revenue growth was good on healthcare as well as toys. So first, if you can give some color on how the inventory levels have moved on a sequential basis. Secondly, the interest cost has moved up very sharply.
Could you repeat? Your voice is breaking a little bit. Could you please repeat?
Yep. So first question is on the inventory levels. On first half basis, the inventory had actually moved up pretty sharply. I presume it should have gone down because you have indicated in revenue that healthcare and toys both have done well. So if you can provide some color on the numbers on inventory and how it has panned out on a sequential basis, that is something which will be useful. The second question is on interest cost. It has moved up pretty sharply on a sequential basis. So that's the second point. And the third is basically how should one look at gross margin movement on a year-on-year basis? Is it purely a function of lag if the raw material prices have moved up, or is it something which is a change in mix? Thank you.
So, Ritesh, on inventory levels, if we were to look at from September 21 to December 21, inventory levels have gone up a little bit. The reason is in this quarter, especially during December, we had issues of container availability. So we had FG which was in stock with us. In fact, our expectation was that we could have had higher revenue as compared to what we achieved if we could have got those containers. So inventory levels are marginally a little higher. We expect inventory levels to come down as we speak over the next 2 to 3 quarters. Your second question was on the interest cost, where you said that the interest cost has gone up. Interest cost has gone up again on two counts. One is till September, whatever debt was raised for the new plastic facility was capitalized till the plastic facility got commercialized. So this quarter was the full quarter when interest cost for the plastic facility was charged to revenue. This was one. Second is on exports, there is this RBI subvention which was 3% on exports, on export financing. That was available till 30th of September. Post that, the government or the RBI has not renewed this, and we do not have clarity on that. So we have paid a higher interest to our banker, and that accounts for the higher interest cost. Gross margins, I do believe, have come down a little bit, but as the raw material pass-through happens with customers, we should get back to normalized margins in the next 2 quarters. That's exactly what I said in September also. We expect by the year end, we'll be getting back to normalized margins, and I would still stand by that.
Sure. Just a follow-up on the first thing. How should one look at the logistic issues? Basically, if one looks at the revenues on a sequential basis, we don't see much of movement. Year on year, obviously, it looks pretty good. Had it not been for the container issue, what the revenue growth would have been? Like, would it be closer to 50%? How should one read into it? And secondly, a related question: how does it impact the viability of the business if the container freight rates continue to remain high for an extended period of time, which you have seen over the last year and a half?
So sequentially, if you were to look at it, we would have had over 10% growth sequential, which in case we did not have the container issue, a little over 10% in terms of growth. So that's what it would have been. I think freight rates have gone up not only from India but across the world. So even if people are importing from China or somewhere else, higher freight rates are being paid. Based on discussions which we've been having with people, we expect that between this quarter and next quarter, you would see this container issue getting stabilized and availability improving. So we should basically be able to get containers and be able to move on. But there are challenges which are there which we need to address, which we're trying to address with our customers.
Right. But is the freight issue, does it eat into our margins, or is it the customer who takes care of it ex-factory basis?
So on exports, customer takes into account. From a landed cost material perspective, it gets adjusted with the customer on a lag basis.
So there is no impact on our margins if the freight rates move up. It is only the throughput which could actually get delayed by a quarter or so. Would that reading be correct?
Right.
Sure. That's very useful. Thank you, Amit. Thank you, Sanjay Bhai. Thank you so much.
That's okay. Thank you. Bye.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Thanks for the opportunity. So first question for you, Amit, can you give us some flavor of the kind of conversations you're having with your clients now that your balance sheet is, significantly strengthened, and, have you been doing more complex kind of products vis-a-vis what Shaily has been doing in the past?
Certainly. I think not just growth and top line, but and customers do recognize that Shaily keeps improving its financial performance and therefore has the ability to take on larger projects. You've seen that happen already with our largest customer, and we also see it increasingly happen not in the toy space as well as on the healthcare side. So we are wrapping up one of our pens to create a capacity of 10 million pens per year, which is of course through the various discussions I've been having and the performance that we've shown on these products.
So are you winning with your largest customer? Are you gaining wallet share of the business that they are buying from India?
Yes, we are. We are the largest plastic supplier out of India, and we continue to grow that business at the same pace.
And at any given point in time, I mean, how much visibility do you have of how big that business could be on a rolling 3-year basis? Or is it always, a 12-month as new programs are negotiated?
There is a joint business plan between the two of us, in the sense between Shaily and the customer. I cannot comment on it, Manish, but we would say that we anticipate aggressive growth at least for the next 3 years.
Okay. My next question is that you just mentioned 200 crore capex over the next 18 months. So just to because we don't. What would that imply in terms of gross block in fiscal year 24 ending?
Manish, our current gross block is a little less than about 300 crores. If we add 200 crores, you'll basically be looking at around 500 crores of gross block.
By March 24.
Right.
Okay. Third question was that, historically, Amit, we put in a lot of capex in the pharma side of the business, and we had issues in being able to sell out that plant. So now, when we are embarking on such an aggressive capex program, do you have firm visibility of business here, or is the belief that, we've got the competency and we'll be able to sell out this plant, or do you see visibility for this revenue?
Manish, I think so we're looking at building about 100,000 square feet of additional facility for pharma, and I would say that all in all we're provisioning for 36 new machines. We have visibility for about 25 of those, which means, and the equipment will be bought in phases. It's not going to be a one-time investment. So we will increase the capital as and when needed, or increase the number of machines as and when needed. But we have far larger visibility today than we did in 2014.
Okay. And any risks you want to talk about, Amit, that you see for the business? I mean, risks that you are aware of, but you'd like to share?
I think biggest risk to our business is, it's essentially human capital. So succession, grooming the next generation of managers, needing additional people is a challenge.
Yeah, we lost our CEO, and now the CFO has also resigned. I mean, why is it that, we've had 2 of our senior people leave us in fairly quick succession?
So I think, with Anil, it was certainly, health wasn't there. It was a mutual decision. Chintan has, I think, realized that he wants to probably be a more active, or probably participate more actively in maybe the startup space of India. So he wants to devote a significant percent of his time to helping startups. And I wish him the best of luck.
Okay, excellent. Thanks, Amit, as always, for all the transparency, and congratulations for all the progress that is being made.
Thanks for your support, Manish.
Thank you. Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Utkarsh Jain from Fintree. Please go ahead.
Hi, guys. Thank you for the opportunity. So I just wanted to ask a follow-up question on one of the questions which were asked earlier. We mentioned that the gross block by the end of fiscal 24 would be about 500 crores. So what kind of asset turn are we looking at on a gross block level?
We would still look at somewhere between 2.2 to 2.25 sort of a thing.
2.2 to 2.5.
I said 2 to 2.25.
2 to 2.25. Okay. See, the reason why I'm asking this question, in the earlier presentation, we used to provide a strategic target of $100 million of revenue by FY20. Right. So I'm just trying to get a sense of how do I visualize Shaily, let's say over a period of 3 to 5 years. How do you see things moving? Where do you think what kind of numbers you'll be able to hit on a very broad level?
Of course, we would refrain from giving more of forward-looking numbers, but I think we're giving in the capex requirements. We're talking about different individual businesses, as well as we recently told you the sales to capex, the numbers. I think you could probably make a sense in terms of what sort of numbers you would be able to.
Sure. But if I take, let's say, an asset turn of 2.25, we're looking at roughly about doubling our revenue. So when do you I'm guessing 2.25 is coming at full capacity. So do you think by end of 2025 we'll be able to reach there?
Because I would refrain again from giving some sort of a sense in terms of the numbers or something, but we're quite confident of the growth which we are talking about, is the way I would put it out.
Sure. No, I just wanted to ask, are you confident of turn on the gross block level at full capacity by end of 25? Keeping the numbers aside, do you think that's
whenever we make the capex, it takes roughly 12 months to ramp up. On average, sometimes more, sometimes a little less. These are large capex, which means we're setting up, facilities. We're not investing in a few machines at a time. So the ramp-up phase would be a little longer.
Right. So let's say about a year from the...
Because we're not going to give you a year. So I think just based on the discussions that I have shared with you, you can probably put in a guesstimate to when that revenue can happen.
Sure. Okay. Understood. Thank you very much. I appreciate it.
Thank you. The next question is from the line of Kaushal Shah from Dhanki Securities. Please go ahead.
Yeah, thank you for the opportunity and congratulations for the results. So just some clarification on the initial remarks that Amit Bhai made. And also I think on some of the answers that so if we are doing something around, let's say 6.5 or 7 million just now, did I hear correctly that we are targeting 20 million in the next 2 years?
Yes.
Okay, because if I remember correctly, we were talking of doubling this number in 2 years and doing 20 in 4 years. So does that mean that we are preponing this 20 million target by 2 years?
So, Kaushal, what we have said on the pharma part of it is we're looking at a 2 to 3x growth over the next 3 to 5 years. What Amit gave you the number in terms of a 20 million pen is we currently do about 6.5 million to around 6.5 million pens across different platforms, which will go to 20 million again across different platforms.
Right. So what I'm trying to kind of just understand is the roadmap towards that. So what we are saying is now we are sort of confident. I mean, obviously I'm not holding on to a particular number. What I'm trying to say is that we are confident of doing 20 million in 2 years. I mean, it could be plus or minus maybe 6 months here or there, or even this number of 20 million could be higher or lower, but directionally we are confident of achieving this earlier than what we had earlier envisaged.
Yes. So we were at the development stage earlier, and today the confidence stems from the fact that our customers have done the filing and have done the validation of the product which has been supplied by Shaily.
Great. And so some more color on the toys segment. Obviously we've ramped up our numbers over the last 3 to 4 quarters. We were also, targeting more business from newer customers like Hasbro, etc. So if you can kind of, maybe throw some more color on that segment and where we expect that to maybe in the next 1 year or 2 years time, what numbers can we do?
So, Kaushal, we had said we are looking at about $8 to $10 million of business in FY22. I think we will achieve that number. As we speak, we did a very large shipment of a very large product for a global toy company and a global entertainment company, a global entertainment brand, which was launched from India for the first time. So this was done very, very successfully. We're now looking at ramping up that business and adding more SKUs as we speak. So we have now commercialized 2 more products, which we will start, or we have started supplying in the current quarter onwards, and we will be looking at ramping up and look at adding more products with these customers as we move forward.
And so, if I remember, this capex plan, we had discussed about this number of 200 crores even earlier, and we had said that 100 crore is towards pharma and the other 100 crores is towards other segments, including toys. So this 8 or 9 million USD that we are targeting in the current year, given the capex and given the visibility, do you think we can, potentially, I mean, again, directionally, I'm not just asking, can we double this number maybe in 2 years' time?
I would refrain from commenting on that, but I think what we have said earlier, and I still stick to that, is from a 3 to 5 year perspective. Whatever we did in FY21 in terms of business with home furnishings, we can get to that sort of a number over a 3 to 5 year horizon.
Okay. But sir, if I do this math of let's say 8 or 9 million, we are already doing again ballpark around maybe 60 odd crores revenue. So that would imply a kind of 2.5 or 3x kind of a growth from that number, because I mean I don't have the number for the Swedish furnishings major. So I'm just trying to do a little bit of directional.
You're probably right. You have the numbers from the home furnishing major if you look at it, because we have said about 55% of it comes from the home furnishing major for FY21. So that number is there, but yeah, you're broadly right.
Okay, great. Thank you. Thank you so much.
Thank you very much.
Thank you. The next question is from the line of Aman Vij from Master Investment Managers. Please go ahead.
Yeah. Good morning, sir. My first question, continuing on the toy side. So we are already running at close to peak kind of run rate, which you have talked about in the last Concall. So when do we see the next ramp up happening in the toy segment? By which quarter are you seeing that ramp up from the current? Because we are already at full kind of utilization, which you have talked about earlier.
Well, I probably did not understand your question. So if you can elaborate a little bit, it will be helpful.
Yeah, sure. So we had talked about at full utilization, we can do that 8 to 10 million or like 2.5 to say 2.5 million a quarter run rate. And sir, we had discussed this during the last con call itself. We are very close to that, and maybe would have done close to that number in this Q3. So I'm saying, when do we see the next ramp up happening in terms of either getting more orders or getting newer customers in the toy segment?
Okay. So we're constantly working on that. As I mentioned to the earlier participant also on the call, that is we're looking at we've just commercialized 2 more toy products, and we will be looking at supply starting this quarter and going over the next couple of quarters. Toy business is a little more seasonal as compared to other businesses. So there are 3 distinct seasons when there is a fairly large ramp-up which happens, and then the ramp-up happens basically when you introduce a newer toy or something. So there will be periods or pockets when there will be full utilization. There will be some pockets when you will have a little lower utilization. So we are also trying to understand and build up a portfolio which can be more balanced around that.
Sure, sir. In terms of gross margins for the different products, so I'm not asking for any number, but is it depending on the size of the, I'm talking specifically on toy segment. Is it dependent on the complexity and size of the product, or is it dependent on the customer to customer, or is it broadly similar across the different customers and different type of products for us in the toys?
It will broadly be more or less similar for different customers. There will be some differences or something, but gross margins will more or less be the same. Again, product to product could have different gross margins depending on the complexity of the product.
So my question was, sir, so you have talked about we are doing much bigger sizes or much more complex products now. So directionally, does the overall gross margin profile of toy segment, do you think this will be much better, say 2 years hence versus what is it today?
I would refrain from answering that. Again, we being in a B2B business would not want to comment on individual segment-wise or customer-wise.
Okay, no issues. Next question is on the, so there is this, in our presentation, loans and advances of 159 crore in the standalone balance sheet. So if you can talk more about this number.
Can you talk about, let me know which page are you talking about?
So sir, page number, slide number 10. So, or page number 11. Where we have given standalone balance sheet in the presentation. There is this 159 crore number in loans and advances.
So that includes the fixed deposit with the bank from the preference share allotment which we have raised.
Okay. Shouldn't it be in cash and cash equivalents, and why is it in loans and advances?
So cash and cash equivalents have basically been taken as exact cash and cash equivalents in the presentation. If you were to look at the balance sheet which has been published with the results, they come in the cash and cash equivalents.
Okay. No worries. My next question is on machine utilization, sir. So we are obviously adding capacities, and that is why it is hovering around 60% odd utilization. When do we see this coming to, so in FY18 we had like 75% kind of utilization level. So when do we see this kind of higher utilization level? Because this will also mean better utilization and so better margins for the overall company.
We should see utilization levels improving next year.
Okay. So do you see 70% plus kind of utilization for the FY23?
We see utilization numbers improving for FY23. I would again refrain from giving in a percentage, but yeah, we do see utilization levels improving as we move forward.
Sure, sir. Final question is on
what we need to look at is we added around 20 plus machines in our new Halol facility, which you're seeing in October, November, December is being available for the full period. So that's one of the reasons why you're seeing that we would basically see improvement as we move forward.
So, sorry, one more clarification on this. So with this 200 crore capex, where will this machine number go to, say, by FY24?
We should ideally be going to around 80% utilization as we ramp up the business.
And the total number of machines, roughly broad range, if you can give by FY24, just to understand.
Will be difficult for us to do that.
What is it today?
It's around 180 plus.
Okay, this is after you include this 20 new machines which we did in Q3.
Right.
Sure, sir. Yeah. Coming to the final questions on the pen segment, sir. So you have talked about scaling this number to 20 million in roughly 2 years. So will the growth be back-ended, or can we see a good growth of, this is like doubling, so maybe 40-50% growth in FY23 numbers also?
We see from the current levels, FY23 to probably only be 20% higher than what we currently do. And the reason is that we need to scale up. We don't have the infrastructure to build more pens. So it's going to take us 12 months to create that infrastructure, and then in the following year we see wrap up.
Sure, sir. And you have, in a way, kind of confirmed orders or quite a good visibility in terms of pen, or any risk you see of reaching this 20 million number?
I don't think we have customers that will confirm orders for 2 years out, but the nature of business is such that if they are buying from us, it's not something they can switch to someone else for. So as long as their ramp up plans are in line with ours, we should see the volume growth.
And sir, do we see do we need to add many more such platforms to reach this 20 million numbers, or do you see from the current set we have, we will be able to reach?
This is for the current platforms. It always happens at least in healthcare, that from the time you develop and commercialize a product to when ramp up happens, you typically have 3 to 4 year period. So we started developing this particular platform about 3.5 years ago, and we are now finally seeing the ramp up of that platform.
Sure, sir. There was this 3 crore number in the other income. Could you clarify more on that for this quarter, Sanjay sir?
We'll revert back on the same. Some of it is basically interest income on the FD, but we need to revert back to that.
Sure, sir. Thank you. That is it from me.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Venkatesh Balasubramaniam from Tokio Marine. Please go ahead.
Yeah, I had a very simple question. I mean, the demand outlook for you looks fantastic. You either have the capacity or you plan to increase capacity to meet that demand. What I am a little worried about is the fact that about people, are there people there to execute the same? Because see, there is a little bit of a concern that the lack of a CEO and now a lack of a CFO. So in terms of managing day-to-day activities, have you already identified people internally who could become the next CEO or the CFO, or you're planning to hire people from outside? Any kind of update on CEO and CFO hiring would be very, very useful.
Sure, Venkatesh. I think your concerns are valid. They also happen to be our concerns. The CEO search is ongoing. We have interviewed and had advanced discussions with certain candidates, but it is something that is not closed yet. As far as CFO is concerned, we have hired a general manager finance who can currently manage operationally at least what Chintan used to do. But I think on a more strategic side, he will need we certainly need grooming over the next 2 years. So Sanjay Bhai and I will be spending the time to groom him into a CFO. And if we're able to find the right candidate and given the business growth, we will look at hiring a CFO as well.
Okay, that was very useful. Yeah, please go ahead.
Our second line of managers have performed exceptionally well. You know, operational second line has performed really well over the last 18 months, I would say. So while there is a need to certainly get a CEO or sort of a chief operating officer, I'd say the current staff has really taken up the challenge and are performing well.
Okay. Thanks for that. All the very best for the future.
Thanks, Venkatesh. Thank you very much.
Thank you. The next question is from the line of VP Rajesh. Seems like we lost the connection for the current participant. We move to the next question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Can you hear me, sir? Hello. Can you hear me?
Yes.
Sir, just like we developed IKEA or even Gillette, almost 3-4 years back, and now they have flowered into huge and regular business for us. How many such developments are we making at this point of time, which will be very small in terms of revenue, but they could move into the same league in 2 to 3 years from today. So how many such developments or trials would we be conducting at one go in today's time?
So first of all, the 3 key areas where we are looking at growth coming in from, in addition to what you mentioned, one is on the pharma space where our IP-led trends as well as contract manufacturing of medical devices. We have been investing a lot in terms of growth for that, and that is what it is going to come. So that's one part of it. Second is going to be toys as we speak, and third is going to be the specialty automotive business which we do, where the business will be small, but it will be a very niche business which we would have as we move forward. So these are 3 areas where we have been working in the past years to grow the business.
So may I request you to repeat the second one, because at that time your line was breaking.
Sorry, I'll just repeat it. What I said was that the second part which I mentioned was on toys. The fourth part which I mentioned was on the pharma-led thing in terms of our own IP-led devices as well as contract manufacturing of pen platforms or medical devices. And the third part which I mentioned was basically the niche auto business which we do, where again, while the business is small, it will grow at a much faster pace in the next 3 to 5 years.
And in all these 4 spaces, we would be having some kind of trials or some kind of progress in terms of approvals, etc.
Yes. So these 3 things which I'm talking about is where we have active discussions, active projects, active business confirmations from customers.
Correct. Yeah. So this means that we are having a very good pipeline of things to come up also. So,
that's what we think.
So these would be like at least 15 to 20 different companies that we will be trying out this with?
I won't get into the number of companies or something, but yeah, we have an active pipeline which we work on with different customers.
And if I may ask, do you have somebody fully in charge of this, who handles only people who are in initial stages of development?
So we have a technical team. Do we have somebody who is in charge of this development?
Yeah, I mean somebody who's heading this like a division, because I feel this is a very important.
What we have, Faisal, is that we have a technical team which is split between pharma and non-pharma, and within non-pharma also we have different teams for toys, home furnishings, and other customers. So there are specific teams which basically work with the customers in development across different verticals.
Okay. You have answered my question very well, sir. Thank you very much.
Thank you very much. Thanks.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, sir. Thanks for the opportunity. One question for Amit. So you indicated that the number of molecules and you indicated how the ramp-up can actually play out. I just wanted to understand the sort of investment which goes into when we go for build-up for any particular platform, wherein you indicated it takes up to 3.5 years. How should one just understand the math if one is looking at it from a IRR standpoint?
Ritesh, your line is very poor. I apologize, but what I understood your question is about the amount we typically invest in a platform or a molecule.
I think that's what I also understood.
Is that correct?
Yes. Yes.
Over that 3 to 5 year period, correct?
That's right. That's right.
Okay. So it's different for different platforms. You know, you don't really have you don't have a baseline, to be honest, because when we acquire IP, it costs us a lot more than when we develop it on our own. But of course, given time value of money and the investment for the time that or the opportunity loss, you know, we're better off with doing a combination where our teams work on creating IP, but we also acquire good IP when it's available. Hard to tell. It can range from a couple of $1 million to as high as, you know, 5, 7 per platform. So not per molecule, because there are multiple molecules on the same platform.
Okay. And if one had to understand the economics between the differential on margins, say between contract versus IP, can one assume that it will be on low single digits or high single digits or low double digits?
So, sorry, can you repeat that, please?
If one had to understand the margin profile for IP versus contract as the mix changes incrementally, just trying to get a sense on how actually the margin trajectory could actually evolve. A broad answer should do fine.
I think on your when you own the IP inherently, you will make better margins, slightly better margins at least, not entirely, you know, not substantially different, but you will make slightly better margins. And again, depends on the therapy area. So, you know, in insulin space is very heavily commoditized, which means you're looking more for revenue and volume than just your margins. So it does depend on the molecules as well.
Okay. So if the margins are slightly better, would it imply that the volumes that we would probably get over here will be significantly higher given it's the company's IP and the competition will be lower?
I didn't understand your question, Ritesh. Could you please repeat?
If we are incurring anywhere, say $5 to $7 million for a particular platform which could have multiple molecules, what Amit indicated is the margins could actually be slightly better. And given we do not have confirmed orders over here, but we have a visibility given we work with a particular company. Does it essentially imply, from a return ratio standpoint, if the IP actually succeeds on a platform, we will be in a position to actually get better volumes on that particular device? Because the margin differential, if it's not much, it has to be compromised or offset somewhere else, right?
Sorry. On our own devices, for example, we've invested, you know, let's say $4, $5, $6 million. Your question is, do we see better returns?
Yes. Yes.
Yeah, I think because given that margins are slightly better, you do see better returns, but it takes time. So I think if you look at it from a maybe an IRR perspective, you shouldn't start calculating IRR until year 5.
Okay. Probably I'll circle back on this question.
Molecule, I mean. Because you always have a pipeline, which means whatever you've developed will wrap up in 3 to 5 years. So there'll be ongoing investments in new technologies. I don't know if that answers your question.
Okay, I'll put it in a simple other way around. What is the probability of getting it right? Basically, if you have invested in 5 separate platforms, will the success rate be 60% or more?
Yeah, somewhere between 60 and 70%.
Okay, that's helpful.
If we've invested in 5 platforms, I'm fully aware that one of them will not do well.
Okay, that's useful. I have a second broader question. How should one understand the export mix region-wise? And is there any risk for any of the global treaties? Basically, you have FTAs which are there. There is RCEP which is there. There are different duties which come in at any point in time. So if one can give a broad sense on the export mix region-wise, and do you think this is something which, how does the management look at it, given the trade remedial measures can come in from any country at any point in time? Is there any risk that the company faces on that count?
So major exports, Ritesh, are to Europe and US.
Okay.
Where we currently do not see any major risk. In fact, what we see is an advantage with the US or the European market is most of our customers are looking at de-risking themselves from China. So we see an opportunity to in fact grow the business.
Okay. And any thoughts on the local policy, be it RODTP, more clarity, or are we expecting PLI on any of the segments where we are operating in?
Your guesses would be probably as good as mine. My sense here is that if I go to look at incentives for exports, what the government has been doing over a period of time is the incentives which have been available for exporters have been coming down, with MEIS not being given to EOU units. As I said, from 1st of October, the interest subvention has not been renewed by the RBI. So effectively, the incentives available to exporters have been coming down, so which is an area of concern which we have.
Okay, and anything on PLI? Nothing of that sort. Any industry representation which has been done?
I think OPPI, where Mahendra Bhai has been the president, has made a representation, but they have not heard back the outcome so far. Similarly, we have been hearing about the Toy Industry Association making a request for PLI, but again, nothing has been heard about it. So,
sure, that's quite helpful. Thank you so much.
Thank you.
Thank you. The next question is from the line of Nikhil from Perpetual Investment Advisors. Please go ahead.
Thank you for the opportunity. My first question is on what is our capital allocation policy? So, for example, now we are aggressively investing for the pharma business. So, is it based on maybe a minimum ROC or IRR or maybe a payback period? And can we expect the incremental ROC to be higher than the existing going forward?
Nikhil, when we look at making investments, we look at 2 or 3 benchmarks. One is, and this would not be looked at from a short-term perspective, but from a medium to long-term perspective. One is the potential for that business to grow and be profitable and sustain profitable over a long-term period. This is one thing which we would look at it. And then there are 2 key matrices which we look at, is either an EBITDA margin or an ROC margin. So these are things which we would evaluate. And based on what it does to overall Shaily is what we would look at. Typically, whenever we would be adding businesses, we would look at that being over that medium to long term, adding to our EBITDA margins or our ROC margins, and that's the way we would look at it.
Understood. So, I mean, with a gestation period, but we can expect incremental ROC or EBITDA to be higher than the existing legacy business in a way. What is our right to win in the business? So is it our people, the process that we follow, or maybe our plant is that high tech, or is it our products? How do we compete with our competition on either of these fronts? Is it a mixture of all four, or is there one element which sort of is advantageous for the company?
So every business will have a different expertise which is required to basically get that business. So that's something which would be unique to every business.
Understood. You mean to say according to each vertical of the business. So maybe for the furniture business it's something else, for the toys business it will be something else. And
within its vertical also, a lot of it will depend on the relationship with the customer, the need of the customer, and everything. It will be dependent on multiple factors.
Okay. So one last question is, can you explain a bit about the business at the new UK subsidiary, and how would it function, and what would be the revenue model at the business?
You want to take that, or I'll take that?
So the subsidiary is primarily responsible for creating technologies and developing our platforms to the point where it is ready for industrialization. We essentially have, I think, two aspects to the platform business model. There is a one-time fee that is charged based on the customizations and developments that the customer needs, which is essentially the cost that we incur in the UK. So that revenue will flow over there, but supplies will be made from Shaily in India. So whatever supplies are being made will flow into Shaily India.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I would now like to hand the conference over to Mr. Amit Sanghvi for closing comments. Over to you, sir.
Thank you. Thanks everyone for joining the call. We hope that we've been able to answer your questions adequately. For any further information, I request you to get in touch with HGA, our Investor Relations advisors. Thanks once again.
Thank you. Ladies and gentlemen, on behalf of Shaily Engineering Plastics Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.